Silver just did something that should be impossible. It crashed by half during a shortage. Its worst single-day drop in more than 4 decades of data, while the market was in its 6th straight year of deficit. Both things are true, and almost nobody is asking the only question that matters: how? Because silver does not move on one clock, it moves on 3. Investor money moves in hours, macro expectations move in weeks, new mine supply takes years, and short-term, the fastest clock wins. Start with the fastest one: money. Silver entered January with a powerful story. Physical supply was tight, the market was in deficit. Then investors piled in: retail, momentum funds, everyone. Silver broke $100, then $121. That looked like confirmation. It was actually the danger. The trade had become crowded. Then, on January 30th, the exit opened. Profit-taking after the speculative surge, Fed expectations shifting on the news of Kevin Warsh's selection, a firmer dollar underneath it all. Stop losses hit. Technical selling snowballed. Belief didn't matter. One day, down roughly 28%. The largest one-day fall in the data, going back to the early 80s. Nothing changed underground. Everything changed in the accounts. A deficit can tighten a market. It cannot stop a crowded trade from unwinding. That is the first clock. Now the second one: macro. Silver has 2 personalities. Industry consumes it, investors trade it. So rates, the dollar, and inflation hit the price long before anything changes in a mine. And this year, that clock did a full reversal. In January, markets expected rate cuts. In June, the dollar hit a 1-year high. By late July, futures were pricing a better than 80% chance of a September rate hike. For a metal priced in dollars, that is gravity. Then it flipped again. In late July, the Fed held at 3.5 to 3.75%, but 3 officials voted to hike, the first triple descent in that direction in a decade. Days later, America lost 23,000 jobs in July. May and June were revised down by another 103,000. Then inflation printed 3.4. The hike case weakened within days. That is the point. A mine cannot respond that quickly. Expectations can, and silver trade expectations first. Now the slowest clock: supply. This is where the bulls have a real argument. The Silver Institute now forecasts a 6th consecutive annual deficit, 46 million ounce in 2026, 15% wider than last year. Since 2021, more than 760 million ounce have been drained from above-ground stocks. The shortage is real, but there is a trap inside it. High prices recruit their own enemies. This is the part silver bulls do not like. Silver demand from solar is forecast to fall 19% this year, the steepest drop on record. High prices taught them to need less. Recycling ramps up. Old silver comes back. The market fights its own shortage. But then you hit the wall. You can redesign a solar cell. You cannot build a mine. One deal shows why. Fresnillo, the world's largest primary silver producer, just put $95 million into Sinda, a developer in Mexico. Sinda's target for first production? 2031. Money in now. Silver out in 5 years. And Sinda's own SEC filing says that date is not yet backed by an initial assessment, preliminary feasibility study, or feasibility study. That is the supply problem in one deal. The world's biggest silver producer is putting money in today behind a project whose first ounces aren't targeted until the next decade. One more thing. Only about a quarter of the world's silver comes from mines that exist for silver. The rest is a byproduct of copper, zinc, lead, and gold. There is no silver tap. Higher prices cannot turn what does not exist. Now put the 3 clocks together. The January rally was never just a supply story. Fast money amplified it. Then the crowded trade broke. Macro reversed, and the price fell faster than physical supply could ever respond. Meanwhile, underground, the deficit kept growing. That is why both headlines are true. Silver crashed. The shortage got worse. They are describing different clocks. And this traps people on both sides. The bull sees the deficit and thinks price must rise. The bear sees the crash and thinks the deficit is fake. Both are too simple. The short-term price answers to the fast clocks: capital, rates, the dollar. The long-term physical story answers to the slow one: mines, recycling, substitution. And here is the uncomfortable truth. You can understand the shortage perfectly and still get crushed by the timing. Right about the next 5 years. Wrong about the next 5 weeks. So why did silver crash while the shortage got worse? Because the deficit was the slowest force in the room. It did not disappear. It lost the race. The question is which clock you're watching, the fast one or the slow one? Tell me below.